Investing is a powerful tool that can help you grow your wealth, achieve financial goals, and secure a brighter future for yourself. But the world of investing can be complex, overwhelming, and filled with risk and uncertainty, especially if you're just starting out on your investment journey. So how do you begin to navigate the wide array of investment options and build a portfolio that aligns with your financial goals? I'm Britt, your favorite YouTube money coach, and today I'm going to walk you step by step through creating a strong investment portfolio without having to hire a financial advisor to do it for you. By the end of this video, you'll be equipped to make confident and informed investment decisions and craft a diversified portfolio that aligns with your goals. But before I start, I want to let you know that we do have a free masterclass that teaches you the secrets of successful investors. So if you're looking to build lasting financial security, it's perfect for you. The link to sign up is in the description. Now first, let me explain why a diversified investment portfolio is crucial for financial success. Diversifying your investments is like building a strong and resilient foundation for your financial portfolio. It's a strategy that helps protect your money, maximize potential returns, and navigate the unpredictable nature of the stock market. All right, now that you know exactly why diversification is crucial for financial success, here are some steps that you can follow to build your own diversified investment portfolio. All right, the first step in building an investment portfolio is to figure out what your risk tolerance and time horizon is so that you can create your chosen asset allocation. So what do we mean by risk tolerance or time horizon? Before you start investing, it's crucial to know what you want to achieve with your investments and how comfortable you are taking risks. Your risk tolerance refers to your ability and your willingness to endure fluctuations or potential losses in the value of your investments. Some people are more risk averse and prefer lower risk investments. Others are more risk tolerant and are willing to take on higher risks in pursuit of potentially higher returns. Your time horizon refers to the length of time that you expect to be invested. So it's basically how long do you have until you need to take your money out of your investment. Your time horizon can vary widely depending on your age, your goals, your circumstances. So for instance, you might be investing for a vacation that's going to happen next year, or a wedding in a few years, or retirement, which may be decades away. Those all have really different time horizons. And generally, when you have a longer time horizon, you can take on more risk and benefit from higher returns. If you have a shorter time horizon, you don't want to invest in something that's too risky because you don't want the value to go down before you need to use it and take it out for that wedding or vacation or college. So understanding your risk tolerance and time horizon is essential because it helps guide the first investment decision for your portfolio, which is asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, cash, and real estate. It involves determining the percentage of the portfolio allocated to each asset class. So here are some example asset allocations based on potential time horizons and risk tolerance. Let's say you're 30 years old and you want to retire by 65. In that case, you have 30 plus years to invest. So you might want to keep 90 to 100% of your portfolio in stocks and 0 to 10% in bonds. This is because you have such a long time period until you're using the money that you can stand for some extra volatility in exchange for higher returns. If on the other hand, you want to retire by 65 and you're 55 right now, you might want to keep 60 to 70% of your portfolio in stocks and 30 to 40% in bonds. This lowers your risk since you don't have as much time to weather the ups and downs of the stock market. The second step is to invest in a diverse set of asset classes. What are asset classes? Asset classes are essentially things that you can invest in that are similar. So some asset classes are stocks, bonds, cash and cash equivalents, alternative investments. Let's talk about a few of these things. Stocks. Stocks represent a small ownership piece of a big public company. It's also known as equities. And when you invest in stocks, you become a part owner of the company and can profit from the company's growth and success. Now, stocks are technically considered a high-risk investment. So instead of investing in single stocks, we often talk about investing in mutual funds or exchange-traded funds, which are bundles of hundreds or thousands of stocks, which gives you instant diversification in your portfolio. We have videos specifically on ETFs, which I'll link to in the description if you want to learn more. Bonds. Bonds are essentially IOUs that are issued by companies or governments so that they can borrow money from investors. When you invest in bonds, you lend money to the issuer and receive interest payments in return. They're a low-risk investment, but they also offer a lower return. Cash and cash equivalents. This includes assets that are easily convertible into cash, like savings accounts, money market accounts, certificates of deposit. These assets are generally considered to be low risk and provide low returns. We have a video on some of the best high-yield savings accounts, so I'll link to that in the description. But just so you know, these aren't considered investments. Instead, these are places to hold your money over a short period of time. Alternative investments include a range of assets that don't fit into the traditional asset classes. So you could consider real estate, commodities, hedge funds, private equity, cryptocurrency. These are all alternative investments. And depending on which type, they can be more volatile and less liquid than traditional assets. Now, investing in different asset classes, such as stocks, bonds, and real estate, can help you diversify your portfolio. Diversification is key to managing investment risk. It safeguards your money by minimizing losses if one investment performs poorly. Diversification can also help maximize your potential returns by capturing growth opportunities in certain markets. And it can reduce portfolio volatility, making it easier to handle market fluctuations. Third step is to choose a mix of investments within each asset class. For example, within the stock market, you can invest in a mix of large cap, mid cap, and small cap stocks, as well as international stocks. Let me break these down for you. Large cap stocks are stocks of companies with a market cap of more than 10 billion. Large cap companies are typically well established and have a long history of stable earnings. These stocks are generally considered less risky than mid-cap or small-cap stocks, but they may also have lower growth potential. Mid-cap stocks are stocks of companies with a market cap between 2 billion and 10 billion. Mid-cap companies are generally smaller and less established than large-cap companies, and as a result may have greater growth potential. These stocks are generally considered slightly riskier than large cap stocks, but less risky than small cap stocks. Small cap stocks are stocks of companies with a market cap between 300 million and 2 billion. Small cap companies are typically newer and less established than large cap or mid cap companies, and so they may offer the greatest growth potential, but they're also the most unknown. So these are considered the riskiest of the three categories. International stocks, exactly like they sound, are stocks of companies headquartered outside of the US. Another way to diversify within asset classes is based on sector or industry. So investing in a variety of industries involves spreading your investments across different industries within the economy. So you're on your way to creating a diversified portfolio. You've created your asset allocation, you've possibly chosen what assets you want to invest in, and the third step is really to create diversification within those asset classes. So let's take the example of investing in stocks. If you choose to invest in stocks, you want to diversify within the asset class of stocks. What does that mean? It means getting a mix of different types of companies instead of all the same company. So you could do this in a number of different ways. You could do it based on the size of company, meaning some large cap, some mid cap, some small cap companies. That just refers to generally the size of the company. And when you have a mix of large cap, mid cap, and small cap in your portfolio, you have more diversification. Another way to diversify would be by geography. So that would mean having some US stocks, some international stocks, some emerging market stocks, for instance. That would be another way to diversify within stocks. A third way would be to diversify across industry or sector, and that is investing in companies that are in technology and healthcare and utilities, for example. Those are three different types of industries. The idea here with all of those types of diversification is that you're not exposing yourself to one thing and one thing only. It means you're getting exposure to lots of different things, either different geographies, different size companies, different industries, so that if one outperforms the other or one severely underperforms, you have exposure to all of them. So diversification is ultimately this way of lowering risk in your portfolio. One example of this is during COVID-19, healthcare stocks did extremely well, whereas the consumer service industry stocks suffered since people weren't able to travel or shop in person. So that's an example of diversification in action, where if you had a bit of each, you would have done okay, but if you just had consumer services, it would have been worse. Fourth step is to rebalance your portfolio. So once you've actually decided on your asset allocation and what you want to invest in and what different diversification within the asset you want exposure to, you want that to actually stay the same. because you've chosen this for a reason based on your risk tolerance or your time horizon. But what's going to happen is that your portfolio is going to naturally shift because some investments are going to outperform others. So it's important to review your portfolio each year and then rebalance if necessary to maintain your desired asset allocation and appropriate diversification. All right, that's it. You're on your way to creating a diversified portfolio on your own. Give this video a thumbs up and leave a praise hands emoji in the comments because now you can create a diversified investment portfolio all by yourself. All right, I hope you feel encouraged and empowered to create your own strong diversified portfolio without having to pay a financial advisor. You can totally do this on your own. And if you really want to master investing, check out our free masterclass. In it, we give you the secrets of successful investors so that you can start building wealth through investments confidently. The link to sign up is in the description. And if you want to learn more about building financial security, be sure to subscribe and hit the notification bell so you don't miss out on our future videos. As always, thank you for watching, and I'll see you in the next video.